Yeah, so the way the waiting period and qualification works, that 2 of 6 activities of daily living or the cognitive impairment is once per lifetime, meeting that. So let's say an example, the question is, what if I start to use benefits and then I recover? Or I don't even get to the 90 days. So long-term care events, first of all, by definition, are expected to last at least 90 days. So if it's a broken arm, that's really not a long-term care event. If it's a stroke or something more serious, that is obviously a long-term care event. So from the day that your needs are established, the clock starts. And let's say you get to day 110. So you did draw some benefit out, but then you were able to go home and you started functioning, everything was working fine, and you're off claim. And then 5 years later, something else happens. You never have to meet that waiting period again. You can go straight into benefit. Okay? While you're receiving benefit, you've got the waiver of premium. Once you recover, your premiums will start up. You do not pay back premiums. You start going forward. Okay? So that's how that works. All right. Who's next? Yes?
Is the Claremont College pool pretty small?
Well, it's not the Claremont College pool. It's the Genworth pool for the entire country for worksite. So you're one of many employers in the Genworth Group Long-Term Care Plan. So it's very large. Genworth actually pays out $5.6 million a day in long-term care claims. They're the largest insurer in long-term care. Okay. So it's a very large group pool, and it is separate and distinct from all their individual policies. It's only worksite employer group plans, and that group plan started in 2006. So not that old. They had 30 some odd years of individual experience, and so all that data and understanding that was gleaned from that was factored into the group plans. So they've never had unlimited lifetime and the higher risky plans. They've always had more contained risk. They've always had an average age that's at least 10 years younger than the individual market, because we're talking to younger people that, you know, in the workforce. Because some of the older individual plans, people weren't even looking at long-term care until they hit their late 60s when this industry first started. So it's an entirely different risk.
And can the benefits be different for a couple?
Yes. Mm-hmm.
Does the employee, if the employee does not want to be covered, can the employee sign his or her spouse up?
Yes. Okay, so a couple of questions. Separate risk pool for the group versus individual, and it's a large risk pool, all employers, not just Claremont colleges. The employee does not have to buy coverage in order to make this available to eligible family members, and you do not have to have the same plans. Each person that's eligible can go in and pick their own plan. But otherwise you could pick, you know, women should pick higher than men. If we're going to live longer, we probably should pick higher than men. All right, so I suggest women look at a 2 to 3 year pool of money and maybe even a higher daily benefit, because we're likely to live longer. Does that make sense? Okay. I want to backtrack to that slide. I want to share some strategies, how I think. I've been doing this a long time. So we call this in the industry short and fat plans. Okay, what does that mean? You might like a $200 a day benefit on a 2-year pool of money better than a $150 a day benefit on a 3-year pool of money. Why? Because at the end of the day, it comes down to what are your daily costs and how much is going to have to come out of your pocket. Does that make sense? So if you have $200 a day versus $150, you've got more coverage each day. Does that make sense? You might do better with a 2-year pool of money at $200 a day than a 3-year pool of money at $150 or $100 a day. Because the key is to not use your money, or to use as little of your money as possible. So even if you ran out of benefit after 2 years, you went 2 years without a lot coming out of your pocket. That gave your financial plan time There was no emergency withdrawals that might not have timed well with the market. Those kinds of things. Does that make sense to everybody? If you're going to do the future purchase option, which is the one that every 3 years you got to buy more, buy as high a daily benefit as you can. You're never going to be younger than you are today. Your first purchase is your best purchase. That's when you're younger. Any subsequent purchases that you make in 3 years from now, you are older. So the cost per dollar of insurance is less today. You can always put it down lower if you found that you got a little in over your head.
Yes, you can reduce it?
You can reduce it, okay? So if you went all the way to 250, and about month 6 you're like, this is so uncomfortable, don't drop it. Call Genworth and reduce it. And just drop down to 2 or 150 or whatever. Don't drop the coverage. I've seen people go from 250 to 0. Like, that was just not a good decision. I get it that it was not comfortable, but that was not a good decision. I would rather have you buy as much as you can and maybe not buy the future purchase options. Does that make sense? Or if you're going to buy the future purchase options, certainly buy the first few and wait, and don't say I'm going to buy this now, maybe later I'll buy a bunch of future purchase options. 2 things are going to happen. One is if you miss 2 in a row, you're not getting any more. That makes sense? And 2, you are 3 or 6 years older than when you started. So those incremental costs of those increases is going to be higher. There's no right or wrong way to do it. I've worked with actuaries in the industry that have bought both ways. Nobody agrees. It's what feels financially good to you. Because I've experienced long-term care at a much younger age, I like having a little bit bigger pool in case something happens when we're younger. Okay, that's my feelings about it, because that's my personal perspective. But a lot of you know your family history, you know what your family struggles with, you know what your family worries about. You know if you're worried about something happening sooner in life or later in life, so you make your decisions in accordance with that. Does that help? All right. Any other questions about this?
Is 3 the maximum?
Yeah. Well, because essentially, remember again, it doesn't really matter if it's 2 years or 3 years, it's how you spend it. So it's
No,
really
it's
one.
a long-term thing.
Yeah.
3 years goes by and boom.
And that's what, well, and if it's, and that's not as common,
No.
but what I worry about is a lot of people worry about not having enough and then turn around and don't do anything because having the big plan. It's like every time you go to buy a car, do you have to have the Mercedes or do you need basic transportation? So I don't want everybody starting at the highest one and then getting completely discouraged. I can't afford the Mercedes of plans here. We need basic transportation, so maybe find something somewhere. Everybody ends up ultimately having a price point in their mind that is going to work in your budget. That's the bottom line. There's a number that works for you, and hopefully it's in that combination somewhere. That makes sense? Because you're going to pay for this until you need it or die. This is not something that you take out here and then 10 years after retirement you stop paying. Never do that. Never stop paying these without talking to a financial advisor. Because for every dollar of protection you got here, that is financial protection on your assets. Does that make sense? That is a couple $100,000 that you are not going to have to pull out of your retirement plan for this. And it's invaluable over time. Right? Yes?
Is there a payout, let's say if you don't use the benefit, if you
No,
die?
because it's insurance.
Okay.
It's like if you don't crash your car. It's insurance, it's not an annuity, it's not a savings plan, it's pure insurance. Now there are plans out there that have that, but they're a lot more money than this because you got all those investment assumptions built into them. Okay, dollar for dollar, standalone long-term care is the cheapest dollar for insurance for this type of need that you can buy. But if you don't think you're ever going to need it, there are people that end up buying, variable products that have a little bit of this protection in them, but you pay a lot more for those products. Okay.
I have a question as far as the payouts go. My dad, a couple of years ago, was terminally ill, and we scrambled to get in-home care providers for him. And some of the people that we hired, you know, they were shifts and stuff like that. And they weren't licensed caregivers. They were people that we were bringing in and paying them out of pocket. Would we be able to pay people like this under this policy?
Yeah, so here's the cool thing also about California. California's definition of a caregiver is more generous than in any other state. And so the carriers have to recognize that. Now, that caregiver can't be the immediate family member, you know,
Right.
so then that would default to that informal care.
Okay.
But you can have unlicensed, as long as the care that they're providing doesn't require licensure. So in other words, unlicensed care provider should not be administering medication.
Okay.
Okay? Now, will they? Probably, but they shouldn't be. So when you submit the claim, that's not something you want listed as something they're doing. They're doing supervision, bathing, dressing, light duty housework, supervising, etc. Things that don't require a license. They can't do therapies, they can't administer medications, so those kinds of things. But yes, this state requires that an informal care provider be treated the same as a licensed care provider as long as they're providing care in court that is not exceeding their skill set or need.
And also, ultimately, he went on hospice care in-home, and he still needed in-home health care providers. That would still be covered even though he
Up to
was-
that daily benefit.
Okay.
So, you know, you pick and choose. Sometimes you can only afford to claim for the home care provider under, you know, you might not have enough room in your daily benefit to claim both, but if you do.
Well, his
great.
hospice care was free, so.
Yeah, some are and some
Yeah.
aren't, you know, it depends on what typically Medicare's picking up some of that. And then it depends on what kind of Medicare plan. Because some Medicare plans don't pick up home hospice. You have to have the supplement, or you have to have the wraparound Medicare plan.
You may have, I don't know.
Yeah, I'm just saying, that's why that hospice is in there,
Yeah.
is because not all medical plans pick up every dollar of home hospice. Okay, so that's flexible for you too. But yes, you can do that.
I have a question. I'm going through something like this right now, actually with my mom, but in case you need to use your benefits, how is it paid out? In other words, do you get a bill from that facility or where you are staying and you're reimbursed by Genworth for whatever amount that you do, or is the billing directly, or how's that?
The only ones that bill directly are the nursing homes. Everyone else is going to bill you and want to be paid by you and give you a billing statement that you submit. And the carriers are really good about turning that around
Oh, yeah.
pretty quickly because it's part of the plan of care that is part of your case file for your claim. And I've been through this a couple of times, and I would tell you that is the way you want it. You want to audit the bill. You want to make sure there's not things on that bill that you are not having done. For instance, we had laundry service that we did not ask for. We had, you know, additional personal care things that we did not ask for. And so, like when you're in assisted living, you're going to have to pay for medication management. They will not let an assisted living patient do their own meds. So that's an automatic. So when you look at the cost of assisted living care, go back to that little piece. That's room and board only. Nobody goes to assisted living that only needs a room and a meal. Okay? So that's the starting price. Then you're going to get an assessment of how much need you have. Do they need to come in every day and queue you? Do they need to do your meds, which they're going to do? So you're going to get that one for sure. If there's dementia, then they're going to charge you for queuing for each meal. You know, so it just depends on what you and your family build into that and agree to. But that's why it's really good to look at the bills. And even with home health agencies, you want to make sure you're tracking home health hours and that their bill and your expectation matches. So that's why I do like having the bill come to you, but that's how that works. Another thing I did mention, do you guys have an HSA? So long-term, is it HSA, health savings?
Well, there's both kinds.
Yep, okay, so the HSA, long-term care premiums are an eligible HSA expense pre-tax. And you know that you can increase, if you didn't put enough in your HSA deduction, you can increase your HSA deduction for your long-term care premium or some portion of it. So just so you know, that's another tax savings for you if you want to use your HSA that way. Saves a lot. Depends on if your strategy with HSA is to put that money away, not touch it, and use it later to pay all your premiums, or if you want to just save tax money now. So that's a personal decision, but know that that's how this works as well.
So when you get that FPO, and every 3 years you make that choice, Genworth has the right to make you go through the underwriting?
No,
at
no.
time?
Those future offers are no underwriting required. They're guaranteed to you.
There's no medical?
Nope. Nope,
Okay.
nope, nope. And that's why if you opt out of 2 in a row, they're gonna stop. They want out of that, I can guarantee you. So if you don't say yes to 2, then you're permanently insurable for more coverage as long as you're buying at least one every other time. And of course, carriers would love to get out of that. So that's why if you 2 and out, you don't get them anymore.
So in your career, would you predict that that FPO goes up more than, the guaranteed 3% inflation, the cost?
So if you just look at the progression of the cost of this illustration, you can see that, yes, every time you get a future purchase option offer, the cost of that 15% increase is going to be higher each time. And there's going to be a tolerance point where you're not going to take any more anyway. We have tracked this through the industry. About 40% of those that are offered it take it each time it's offered.
Thank you.
You're welcome. And then by about 70, 75-ish, people stop taking them and lock and load. But you made it to that age. You know your retirement assets. You feel good about what's going on. You're in retirement. And so if you've got to come out of pocket and bridge the gap, you're in a better position to do it. And you protected the growth of those assets during your working years, so if something happened now, you didn't have to touch that money. Does that make sense? This really is retirement protection. This allows you to let your retirement do exactly what you want it to do and not derail it. So that's really how I see this, because nobody really wants to talk about what long-term care is, nuts and bolts. It's hard. It's painful. All right. All right. Thank you for your time and attention to this.
Yeah, it's very informative.
How long does it hold the bed for you? I'm just curious.
Up to 60 days.
Oh, okay.
You probably won't be gone that long, but you never know.
Yeah.
Thank you all for taking the time to look into this matter and seeing if it's right for you. Take care.